But without further ado, I'm going to introduce our next guest speaker for this session. That is the Secretary for the Department of Agriculture, Fisheries and Forestry, Victoria Anderson. Now, Victoria was appointed Secretary in December 2025, and she's gathered over 25 years of experience in public policy and governance roles, including 17 years in the agriculture portfolio, which is where I believe she began as a graduate. She's held a number of senior executive roles in the Treasury, the Department of Education, Skills and Employment, and the Department of Agriculture. The Secretary's interest in Australian food and fibre industries is long-standing, having grown up on a stud beef property in Queensland. Please welcome to the stage Secretary Anderson. Thank you. You go first.
Good morning, and thank you very much, Claire, for your introduction and warm welcome. As Claire alluded to in her introduction, while the role is new for me, the portfolio is not, and it's certainly a great privilege to have returned to the department as Secretary. I'm pretty sure, although it won't withstand a fact check, I don't think, that I attended my first Outlook conference nearly 2 decades ago, when the worth of the sector was in the order of $61 billion, and I was sporting my natural hair colour. Now we are here today witnessing, it's mostly natural, just a little bit not. Now we are here today witnessing the breaching of the previously elusive $100 billion barrier, which is quite extraordinary. This milestone is testament to the people who grow our food, manage our land, support our regions and shape the future of Australian agriculture. And we're lucky enough to have many of them here with us today. Australian producers have long understood the value of information, statistics and forecasts that help them to prepare for the future. I think this is one of the reasons that ABARES and the Outlook conference have stood the test of time. Another reason for this longevity is that ABARES is always investing in the next generation of economists. And on that note, we're about to talk commodity forecasts with Gen Next. It's genuinely energising to see the fresh talent coming through the Bureau, building on more than 80 years of trusted data and analysis that helps tell the story of Australian agriculture. Before I hand over to the Gen Next team, I want to briefly reflect on what has enabled Australian agriculture to perform so strongly in an increasingly complex environment. Realising the $100 billion goal well ahead of the 2030 timeline is an achievement the sector can rightly be proud of. Anyone who deals with seasonal variations, volatile markets and constant uncertainty knows that results like this don't happen by chance. They reflect strong partnerships between industry and government, along with our world-leading research and development system, all working together to respond to changing consumer expectations and shifting market conditions, both at home and abroad. The value in these partnerships is reflected in the sector's productivity growth, a key contributor to the $100 billion achievement. Not only has broadacre farm productivity grown consistently over the long run, productivity growth, on average, has outpaced the broader Australian market sector over the past decade. This was something I made sure to mention at least 10 times to my former Treasury colleagues when my move back to DAFF was announced late last year. Love a bit of showing off about agriculture. At DAFF, strengthening productivity also includes helping businesses remain competitive in a more volatile climate, and a big part of that is supporting better decision making. ABARES' independent data, forecasts and analysis have helped the sector understand markets, seasonal conditions and global trends so businesses can plan with confidence rather than react. DAFF also works closely with states and territories through the National Drought Agreement to make sure support is there when farmers are doing it tough. But just importantly, we're investing in the skills, knowledge and capability that help businesses plan ahead and adapt. That focus on resilience and innovation is what helps Australian agriculture remain competitive and sustainable as climate risks increase. Australian agriculture already has strong sustainability credentials, and our international success is built on a hard-earned reputation for safe, high quality and sustainable production. Recent ABARES work shows that adoption of natural resource management practices is widespread across the sector, with chemical and fertiliser use operating at world's best practice levels. Over the 3 years leading to 23-24, around 92% of broadacre and dairy farms undertook at least one natural resource management practice, helping contribute to sector-wide sustainability. This focus on sustainability has positioned Australian agriculture to meet consumer expectations and better manage the 55% of the landscape of which they are stewards. We've seen strong returns from the joint investment of industry and government in the RDC model, which with every $1 generating $8 in return. We're so fortunate to have this unique model, which leverages funding from industry levy payers and government to drive long-term productivity, sustainability and resilience, with benefits shared across the sector. However, as we heard earlier from Jared and Maximo, while the sector has recently experienced a period of growth, we cannot assume this growth will continue unimpeded. In agriculture, we know that community and consumer expectations are rising and changing. Climate variability continues to shape production and investment decisions, and at the same time, the net zero transition is placing a sharper focus on emissions intensity across the sector. The sector's productivity growth, while still strong, has slowed, and we are increasingly operating in an unpredictable global trading environment. As we've seen over the last weekend, things can change on a dime. These challenges are real, but how we adjust to them will help define the next period of growth for the sector. One opportunity comes from the projected rise in the value of Asian agri-food consumption, over 45% between 2020 and 2050, driven by rising incomes, population growth and urbanisation. The sector has done a lot of work to capitalise on this growth, though competition remains intense. The department will continue to work closely with industry to seize opportunities such as these and to reset and regrow, a theme we'll be exploring further over the next couple of days. There are also particular opportunities for the sector as Australia transitions to net zero. While our producers already have an enviable record of delivering low emissions food and fibre, carbon sequestration is going to become an increasingly important part of how the land is used. Many people forget that managing carbon in the landscape is not new. Farmers have been doing it for decades. What is new is some of the opportunities. Emerging carbon markets allow this work to be recognised, valued and rewarded, creating new income streams alongside food and fibre production. As Jared mentioned earlier today, by 2050, sequestration projects are estimated to deliver around $9 billion a year in profits to landholders, while reducing abatement costs across the economy by $7 billion annually. The Australian Carbon Credit Unit Scheme, or ACCU scheme, as it's known, plays a key role in incentivising carbon sequestration and emissions avoidance. Farmers can generate ACCUs through a range of eligible projects, including soil carbon, environmental plantings and plantation forestry. Across the sector, a growing number of farmers are already demonstrating the value of participating in the ACCU scheme. We know this is not an easy pathway for everyone in the sector, and that it takes time, confidence, and the ability to navigate new markets alongside doing your core business. However, the opportunity is real, and environmental markets can provide valuable additional revenue to smooth out fluctuations in farm income. With widespread uptake, the market could also deliver meaningful benefits for regional economies while making a significant contribution to Australia's environmental sustainability. No speech should occur from a DAFF Secretary without talking about biosecurity. So the success of our $100 billion agricultural sector has been underpinned by our strong biosecurity system, in which both government and industry have made significant investments. Australia's biosecurity system always comes under heavy scrutiny, domestically and globally, and rightly so. Getting it right or wrong has a material impact on everyone participating in our trade environment. Fortunately, our system is widely recognised as one of the strongest and most comprehensive in the world, and it is working. We remain free from many potentially devastating pests, such as the capra beetle, which could cost Australia $15 billion over 20 years if it became established. But while the system has served us well, it's also operating in an increasingly complex risk environment. Growing trade volumes and passenger movements, shifting global trade and travel patterns, and the impacts of climate change all contribute to heightened and evolving biosecurity threats. When I was last in this portfolio in 2017, we were seeing around 43 million cargo consignments annually. Last financial year, there were nearly 155 million. That's a 264% increase, which of course significantly increases the pressure on our system. We know that a single biosecurity outbreak can have far-reaching consequences for our economy, environment, national security, trading relationships, and even our way of life. We can't reduce our biosecurity risk to zero, but we can work collectively to manage and mitigate threats, maintaining the incredibly high standards that underpin Australia's agricultural productivity and enable our growers and producers to compete globally. Strong biosecurity depends on shared responsibility and strong partnerships at every level, because the outcomes affect us all. As the Minister emphasised earlier today, agriculture is an incredibly important part of Australia's export story. With around 70% of what we produce exported, the sector accounts for nearly 12% of Australia's total goods and services exports. Our farmers don't receive subsidies like those in many other countries. To remain competitive in a global market, we must be able to navigate the increasingly volatile world of international trade. My department gives life to our trade agreements by negotiating and maintaining the technical conditions that underpin agricultural market access. These outcomes are hard fought behind the scenes. They are often built over years of dedicated technical work and very close partnership with industry. When agreements are secured, like recent access for Australian blueberries to Vietnam or reopening access for Australian rendered products for animal feed to Indonesia, they deliver real results, new opportunities for farmers, stronger returns at the farm gate and greater certainty for investment. And this is something I think we can all take pride in. Before I hand over to the GenNext team, I want to take a moment to acknowledge the sector and the strength of our partnership. At DAFF, we see the relationship with the sector as foundational to everything we do, whether it's our ABARES farm surveys that rely on producers' input and support, our trade and market access work where we need to work hand in hand as Team Australia, or the way we communicate about how to take up new opportunities, including those arising from the net zero economy. We exist to support your growth, competitiveness and resilience, and that means listening closely, engaging early, and shaping policy outcomes alongside those who live it every day. We will always achieve much more together than we ever could alone. Thank you.
But we're going to head over now onto our next panel, and we're going to be delving in a little bit to the numbers and some of the industry detail behind that big headline figure we've been hearing this morning, that $107 billion output. And we're going to be kicking off with our Commodities Spotlight panel. I'm joined on the stage by a panel of ABARES commodity and farm data analysts who will shortly be discussing the medium-term economic outlook for key agriculture, fishery and forestry sector commodities and farm incomes. I'm going to hand over to Jared Greenville to facilitate proceedings. Over to you, Jared.
Excellent. Thank you, Claire, and thanks, Vic, for that introduction to what we're going to really kind of talk about as well today. The only other thing I'd say is, we've got our next generation, the people who really know stuff, but just to compound that for me, everyone's getting taller and they've put me in a really low seat. So I really know that, I'm aging in place, but so it's a good way to start, just to be kind of where put me in my place, really. But in this session, we really are going to kind of get into the industry level dynamics that sit behind those high level numbers that we put up. Agriculture at $101 billion. We've got a $3.94 billion fishery sector and a $2.2 billion forestry sector, with those exports about to hit about $85 billion. But there's a whole range of different things going in, and Maximo gave us a good kind of picture of international dynamics, where things are at. So rather than hear from me with a high-level story, it's good to hear from the people who actually know something about what they're talking about. And I'm joined in stage by these wonderful people who work for me across our different areas. And we'll go introductions as we kind of go along. There'll also be time for questions, and so we'll take questions both from the floor but also from the app. So as you think about them as we go along, feel free to use the app, or if you want to get more involved, jump up and put your hand up. There's those flashing light things which you could give a go to just to make sure we don't miss you, or you could do a more traditional way just by raising a hand. But before we go into questions, let's kind of get a picture of where the sector's at and where it's been. And so I want to start to talk about crops. And I'm joined by Amelia Brown, who will take us through the crop forecast. Now, Amelia, global markets, global production, they all seem to be playing a role in sector performance at the moment. And as we look to next year, so will the weather, clearly. Can you take us through how things actually shaped up this year? And I think that was, for me, was one of the standouts. And what factors were really expecting it's going to drive our performance as we go into next year?
Yeah, thanks, Jared. There's certainly a lot going on in global markets at the moment. Obviously, the last 4 days or so have thrown a few things, I guess, out of whack globally in terms, plenty of volatility. Fuel prices, fertiliser prices, grain prices have reacted very quickly. Despite this volatility, if we take a step back and look at the fundamentals underneath what's happening in the sector, we might get a better picture of what's in store for the year ahead. I mean, domestically, we've just produced the second biggest winter crop on record at over 68 million tonnes. Western Australia had a fantastic season and they've produced a record crop. And despite some pretty challenging conditions through Southeast Australia, production has exceeded expectations for many, particularly in South Australia and Victoria. I mean, they had a very dry start. A lot of crops were dry sown, but really timely winter rainfall got crops away. And then just the timing of spring rainfall and really mild spring temperatures has enabled some pretty impressive yield results, particularly through those southern cropping zones. And again, I think we've seen this the last couple of years. It really is a testament to improved agronomic practices that conserve soil moisture, better seed varieties. We are really seeing some impressive production off not that impressive amount of rainfall. In terms of our production estimates now, we now see wheat at 36 million tonnes. It's the third biggest crop on record. Barley is estimated to increase to a massive 16.3, which is easily our biggest record barley crop. And I think that's a reflection of the late start to the season, growers pivoting towards barley, putting more in a bit later on. And then that really mild spring just really boosted the yield outcomes for barley through southern cropping regions. And similarly with canola, we now estimate canola at 7.7 million tonnes, which is our second biggest canola crop on record. And we've also produced a record pulse crop. So in terms of performance, it has been quite outstanding considering conditions weren't that great through parts of the season. Despite this great result, unfortunately, we're not the only ones in the world who've had great production results, and we are looking at record global grain supply. It has been quite unusual over the last 12 months. Normally, you would expect somewhere in the world to have some sort of production issues, and we just haven't seen that. All of the major producers, major exporters have had pretty good seasons with record production for a lot of the grains we produce, wheat, barley, corn, and oilseeds. Particularly relevant for us, Argentina has just produced an enormous wheat crop, 9 million tonne increase year on year, and it's 6 million tonnes higher than their previous record. And again, that is a reflection of, similar to what we're seeing, improved agronomic practices, better varieties, and so I think we can probably expect to see that sort of level of production going forward. Obviously, we compete with them into a lot of our major export destinations. The strong Aussie dollar is also creating some headwinds for us in terms of competitiveness, and we're seeing that in suppressed domestic prices. As you can see from those charts, despite the big volumes of production I've been talking about, it really is the price story that's pushing that value down. But looking at the year ahead, we are at this early stage expecting production to decrease. We're not expecting seasonal conditions to be quite as good at this stage. The current outlook is for an increased chance of below average rainfall through autumn and into early winter, which is obviously not great. Having said that, we have seen some amazing rainfall through SA and Vic over the last week where it was desperately needed. So that is really good for them in terms of setting them up for the season ahead where it has been really dry. Obviously, lower production will flow through to our export volumes and value in the year ahead in 26-27. And in terms of global production, we'll be keeping a close eye on Northern Hemisphere spring crops as they come out of dormancy. There has been concern about winter kill in some major producers, Russia, Ukraine and the US, but overall the crop globally is in pretty good shape. And so we're looking at another heavy balance sheet moving forward. So although we are going to see some short-term volatility with everything that's happening, depending on how long it goes on for, the world balance sheet is pretty heavy and it might be difficult going forward to the year ahead in terms of our exports and things like that. But yeah, that's a bit of a wrap-up of what's been happening.
Excellent. Thanks, Amelia. Yeah, there's a bit going on, but as you say, like coming back to where we started the conversation last year and where we ended up this year in terms of our production balances in South Australia in particular and Victoria, I'm still, I keep on looking at the numbers again and go, wow, okay, that did happen. So it's quite an amazing performance. Staying with crops, or staying with plants, I guess, more apt. So horticulture I wanted to shift into, which has really been a kind of a story of long-term growth, aggregate year-on-year growth and success. And also we'll ask Tom Killalea here, who's going to talk us through these forecasts, to touch on the wine industry, which has been experiencing a bit of hardship, largely on the demand side. Tom, when we look at the aggregate number of horticulture, it seems like an unstoppable force. It's increasing year on year, but I suspect that there's a whole bunch of things going on underneath that headline number. Could you unpack a bit what's going on under that number and where some of those dynamics are, and also where we see the outlook for wine?
Yeah, sure, Jared. So yeah, that's correct. At the aggregate level, horticulture does look like a steady growth story. But when you look beneath the hood, it's a little bit more touch and go. And that's quite similar to what we're seeing in the wine industry too. So if we start with horticulture, we can see that the overall value of production is forecast to rise again this year to $19 billion. And that's supported by higher volumes and generally solid prices in export-focused commodities. Fruit and nuts are leading this lift. Dry seasonal conditions have supported yields in citrus and tree nuts, with almond production continuing to expand behind increased bearing acreage, and macadamia is rebounding significantly after a bit of a weaker year last year. Now looking forward to next year, and as we can see, more records are actually projected. However, this will be against a tougher global backdrop. Increasing global production and a firmer Australian dollar will weigh on competitiveness. That means success won't really come from just producing more. It will also depend on retaining current export markets and being able to diversify into new ones. So yes, the top line, it is growing, but we'll have to see if global demand can really keep up with global supply. Now, Jared, if we turn to wine's had a far more volatile decade. After the reopening of mainland China, we saw a temporary surge in premium exports, but that momentum just hasn't really held. Global shipments have softened, with weaker demand in the UK, US, and even China compared to previous peaks. At the same time, domestic production has lifted while sales growth has slowed. That's left the industry with particularly elevated inventories, especially amongst bulk wine. The result, as we've seen this year, has been sustained downward pressure on grape prices across premium and inland regions. So looking ahead to next year, we'll start to see that the challenge is structural and not cyclical. Global wine consumption is no longer expanding the way it once did. Younger consumers are drinking less, cost pressures are biting, and competition for discretionary spending is now starting to increase. That's why the sector will need to start to rethink its strategy, focusing perhaps less on volume and more on value, diversifying export markets, strengthening branding, and aligning production more closely with demand will be critical. So Jared, I guess if we step back, horticulture is growing, but selectively, whilst wine is starting to adjust and a little bit more fundamentally.
Thanks, Tom. And I suspect that some of those pressures in input markets that Amelia touched on as well will flow through to horticulture producers as we go. But on wine, that reminds me, we've got a chance to support the Australian wine industry later on tonight at our Sundowners. So please stick around and do your bit, because it's a great product and we should all drink more of it. That's not health advice. It's about diversification of diets. But on that note, shifting, I guess, with pairing and thinking about, where we're going to go next, it's worth looking at livestock. And we've got Fritz Litchfield here who will talk us through our livestock forecasts. This year, it seems all about US hamburgers, really. We've heard a lot about that, a lot about how that's driving global demand and helping us hit records for our livestock sector. Now, Fred, I understand though it's not all about hamburgers, but there's a bit of maybe a nuanced story and what else is going on. But can you have a kind of take us through what has been driving some of these numbers that we've seen in our livestock markets and what we might be looking at for next year?
Yeah, thank you, Jared. That's exactly right. What we've seen is that really sort of insatiable US demand for beef has been the biggest driver of higher sale-yard prices for cattle here in Australia this year. And that's leading to our forecast for record beef and live cattle production of $23 billion there. The US has become our most valuable export destination, with processors competing across Australia really to secure cattle for slaughter package up the meat and get it in a shipping container for export. Higher production value has also been driven by elevated turn-off on farm. Given relatively low pasture growth across large regions of eastern and particularly southeastern Australia, looking ahead to 26/7, we're anticipating a moderate fall in production value, as you can see via the light blue line on the chart, but it's still forecast to be the second highest on record. It's buoyed by really good pasture growth across really large areas of Queensland and Northern Australia. But what we're expecting is lower demand for beef imports in China, and this to flow through back to lower demand and prices at sale yards for cattle here in Australia. The introduction of a tariff rate quota into China is going to limit how much product we can send, but also push prices down in other markets as we compete with other suppliers to find new homes for our beef. That includes increased competition into the US. For our sheep industry, Jared, we're anticipating another really strong year in 26/7 on the whole, on the back of wool prices being a little bit higher and lamb prices really remaining close to the records that we've seen this year. However, unlike beef, the story has more of an Aussie flavour because we're the world's largest exporter of both sheep meat and wool. What's driven record production value this year is again increased processor competition to secure sheep and lambs for slaughter. However, sheep have gotten harder to find after several years of pretty elevated turn-off across southeastern Australia. And that's led to prices hitting records this year. I mean, just huge records for lambs and mutton. In addition, some producers that have had better pasture growth are looking to rebuild flocks, and that's also led to demand and higher prices at sale yards. Similarly, on the wool side, competition amongst Chinese processors in particular to secure wool off a smaller Aussie flock is leading to higher auction prices, and we're thinking that's going to sort of maintain and increase a little bit in 26/7. For dairy, high global supply this year, particularly in New Zealand, the US, Europe, what we're thinking is that's going to lead to a lower Australian farm gate milk price next year in 26/7. And the first announcements usually come in around June. And we're also expecting a moderate fall in cow numbers to lead to lower milk production. For pig and poultry meat, Jared, we're actually forecasting next year to be a record, led by really strong domestic demand here in Australia.
Thanks, Fred. Some interesting dynamics there across the different markets, and it's a good thing you point out that often when we face trade disruptions occurring, it's not just that first round impact of us selling less into China. It's the second round where you get the displacement of other product because it's not just us who are impacted, which impacts our markets. But all these things we've just been talking about also flow through to one of the metrics that's kind of really important for the sector, and that's farm cash incomes, farm profits, and effectively farm returns for those households. And that's a good measure of how much money is actually getting into regional and rural Australia. So we've got Sean Bellew, who joins us from the Farm Performance team today, and you'll also see him at the ARDI booth, the Australian Agricultural Drought Indicator booth outside. So very, very clever man. And so Sean's going to, despite what we've seen about kind of drying conditions, but also, I guess the number of these other factors that we're seeing with prices and the like, can you take us through what are the implications have been for farm cash incomes and profits, and how are farms faring across the country?
Yeah, absolutely, Jared. And you made some good points there. And probably unsurprisingly, based on what we've heard Amelia and Fred talk about just before, it was a really good year for farm profits in 25-26 this current year. It's a lot of that uncertainty and some of those calling off of production and that price story that was covered earlier is seeing us probably fall on average. So we're currently forecasting for the average broadacre farm the profits to fall to $126,000 for the next financial year. We can see cropping farms in the dark blue just at the top there are really the big contributor to elevating those average farm profits, and that fall in production we're expecting to see for the next financial year is the big driver of that easing, as well as that continued strong global production is linked to easing prices a little bit as well, particularly for wheat for the next year. So that's also lowering the value of that production as well. And it's a bit of a wait and see in the conditions. Like, so we're very early out here for the next financial year. The others touched on how it'd been a bit of a dry start to the season, even though there has been some timely rainfall across SA and Vic. But there's definitely a lot of wait and see of that, and that's quantified there actually in those upper and lower bounds with those grey dotted lines. And cropping is really sensitive to the climate, so there's certainly scope for a range of outcomes depending on how the climate situation plays out over the next year. It's a bit of a different story with the livestock, so especially on the price end, like Fred just covered how the prices have been great for sheep and beef over this current year. And then next year, if we look at the sheep profits, it's a little hard to see squeezed in there with the beef, but we're expecting probably a reasonably steady profits for sheep farms next year. And that's as those sheep and lamb prices are expected to remain elevated. And whilst there's some dryness still, we're largely forecasting a neutral climate for the next year. So we're still expecting those to remain a little bit elevated compared to recent years. So it's certainly not the highest on record or anything like that, but compared to especially across Southern Australia, where it had been really those drought conditions in the preceding years. Certainly compared to those, it's definitely a more positive story. And for beef, again, really strong prices as well. As Fred touched on, easing off a little bit compared to this year for the next year, but it's still really good price, and still expecting good conditions across those beef farms in Northern Australia, even if maybe they're not as high as what they've been in the past. Still expecting it to be, really strong. And both the sheep and beef prices, values there, and production is supported by the fodder price. We're expecting it to just ease off a little bit in next year as well, so that might help to mitigate some of those dry conditions as well. And on the cost side for all those farms, costs have been pretty high over the last 5 years. They really shot up around the turn of the decade, and they've really stayed there, even if it's been up a little bit year on year, certainly compared to how it's been historically. So that's certainly weighing against the profits, even with good production and income. And as Amelia touched before, with some the recent events playing out, it'd be a bit of wait and see on how some of those input prices go. So that's certainly something to keep an eye out as it plays across the next year. But really, in summary, like it's generally a fall in farm profits for the next year. And part of it is due to how well farms have been performing this year. So still better than some of those really bad years, but certainly, expecting to ease off a little bit.
Excellent, thanks, Sean. And as the team knows, I know them a lot. I'm a keen watcher of our terms of trade index, and we're seeing that, as Sean pointed out, it's kind of fallen again this year, and we've seen that kind of trend over the last few years, and it's an important determinant of those lines you see there. And the other kind of interesting thing you really draw out is that while we come up with a forecast, there's an error bound, and we can articulate it here, and because there's the seasonal conditions could take us either way. But it's an interesting kind of story, but still positive, I would say, overall. So I want now to shift to the other kind of two sectors that are key parts of our primary industry set, as we call them. So our fisheries and forestry. But we'll start with fisheries and agriculture. Noting that it makes an important part of kind of, I guess, the overall story of what we talk about as a department and at ABARES. But like agriculture, it's exposed to international markets, domestic economic conditions, importantly climate conditions, which also may play a role, and also trade disruptions. So like the other commodities we've spoken about. I'm joined here by Harrison Tuynman, who will take us through our fisheries forecasts. Now, I think one of the things when we look at fisheries and agriculture, it's also worth taking a bit of a longer view and looking back a little bit to understand what might be going on as we look forward. But can you take us through what has driven some of the fisheries and agriculture production in recent years, and where this may take us as we look ahead?
Yeah, well, I think in the news and whatnot, we've seen increased reporting on fisheries across all the products, and with particular attention on salmonids and rock lobsters, which really drive the movements in fishery values across the years. So in terms of aquaculture, big sector, the Tasmanian salmonid industry, as you can see, there's experienced 2 decades of rapid growth, and we can see this in the aquaculture performance up to 22-23. Since then, however, production has fallen back from its peak of around 80,000 tonnes to sit around 70,000 tonnes per year. And a lot of this reporting as well has also been linked to some of these environmental concerns, particularly following the mortality event around this time last year. These concerns have really put a pause on expansion. So we expect volumes to remain pretty steady into next year. On prices, this year global supply has been higher than expected, particularly from major producers like Norway and Chile. And this has softened international prices and kept the domestic ones pretty flat. But next year we do see, we will expect to see a modest recovery as international supply conditions normalise. We'll see with some of these issues affecting the world at the moment, but lifting the value of salmonids to around $1.26 billion. Looking at the medium term, we expect production to increase again with capacity available in Storm Bay, Tasmania, increasing back to around 80,000 tonnes per year and increasing the value of salmonids in real terms heading out to 2030-31. And Jared, while the previous years salmonids have seen a bit of decline, the return of rock lobster to the China market, we've seen a real recovery in value. And along with re-entering the China market, we've actually benefited from lower competition with weather and trade issues affecting the Canadian live lobster export market. And as a result, we expect the values to have increased substantially this year. And next year, this rate will slow as the Canadian tariff barriers are reduced this month. But we still expect an increase peaking around $760 million for next year. Looking ahead though, an appreciating Australian dollar will really start to impact our export-orientated products like the rock lobster, reducing our competitiveness overseas. And for some of these other products like abalone and prawns, there's really strong international supply, and which will keep our prices fairly restrained. Or in the case of tuna, the weaker Japanese yen and falling demand for tuna in that market is really hampering our export growth. So Jared, actually overall, despite some pretty significant movements among individual fishery products, we expect the overall sector in aggregate to remain fairly steady around the $3.9 billion mark in real terms, heading out to 2030-31.
Awesome. Thanks, Harrison. There's some really interesting dynamics here across the different products. Rock lobster, it's a bit of a change, and as you're saying, like we've heard a lot about aquaculture recently, much more I think over the last year than we have previously, and we see that both in the numbers as well as in the news as we go on. So now I think turning now to forestry, and I'm joined by Vincent Hemmings-Kavanagh, who's going to talk us through our forestry forecast. Now, interest rates and building costs seem to be part of the general economic narrative that we hear these days, and they also play an important role in determining some of the outcomes that we see in our forestry sector. But one of the complexities, and I'd feel for people trying to manage this in the production side, that we also know about forestry has very long production cycles compared to other industries. You can't just plant it this year and harvest it in a few months later. But what are some of the developments that we're seeing in our forestry markets, and how are they likely to influence our sector value?
Yep. Well, as you mentioned, Jared, interest rates and building costs are influential factors in construction markets that have flow-on implications for wood product demand. However, changes in housing preferences and the tail-end effects of the home builder scheme seem to be having just as large, if not more, influence on forest and wood product demand. So the home builder scheme, which was implemented during COVID, was designed to increase near-term construction activity, which it did, but had the general effect of bringing forward construction sector activity rather than increasing overall construction levels. Potentially more importantly, what we've also seen since COVID is an increasing trend toward higher density and higher rise construction. This is important for our softwood sector because higher rise and higher density construction uses a lot less timber than in detached houses. So while we're expecting increasing dwelling construction rates over the coming years, we are not expecting to see the same long-term increasing construction rates in detached houses. So contrary to this muted growth in supply for domestic saw logs, softwood saw logs that is expected to increase in the near term as our plantation estate cycles through mature stands. But what we've also seen over the past few years is average harvest levels being below the level of mature log estimates, indicating that there may be increasing standing stock in the plantation estate remaining unharvested due to these softening market conditions. So putting this all together, this muted growth in demand and increasing domestic supply is likely to result in lower average prices for the softwood sector. So alongside the softwood plantation estate, we also have a hardwood plantation estate, which is focused on exporting wood chips to global markets for the production of paper and packaging products. So globally, demand for paper and packaging has not continued to increase, as was once expected when we're in the height of our online shopping frenzies during lockdown. So globally, these significant investments in paper mill capacity, combined with these consumer demands falling short of expectation, has resulted in these large and growing stocks of paper and packaging products. So these stocks mean that annual demand for newly produced paper and packaging is expected to be reduced in coming years, and hence demand for wood chips will also be reduced. Alongside this subdued global demand, Australia has also transitioned away from being the main supplier of wood chips to China. Now, this transition has been driven by Vietnam's growing dominance in global wood chip markets, which is supported by the lower unit prices. And finally, Australia's hardwood native sector, which is focused on supplying high-value saw logs for their structural and appearance-grade properties. This is a highly regulated sector and has been declining for multiple decades due to increasing transfer of multiple-use public native forest to nature conservation reserve. So we can see there are a number of challenges for the forestry sector at the moment, which are compounded by the long production timeframes you mentioned at the beginning. So the forestry sector is facing these changing market conditions, but the supply of logs is coming from trees that were planted up to 30 years ago. So this challenge is not going to be a once-off for the forestry sector, because the sector also needs to look forward and to align future log supply, which is being planted right now, with a future market that is likely to look very different than today's.
Thanks, Vincent. Some really interesting dynamics, and particularly that shift in housing composition, and we're building differently, and how that impacts the timber demand, and making decisions today for 30 years where you might get, macroeconomic or economic shocks that change value considerably. So it's interesting, but so a big thanks to everyone on the panel for kind of taking this run through the different commodities. I can see that we've got some questions, so I think we should be able to go. So what I thought we might start off with, we'll take a question from the app, and then we might open it up to in the room, just so you can kind of get your question vibe up and running. So Claire, I can't see you, but I know you're there. Do you want to maybe kick us off with a question, and then we'll flow through to the floor?
Yeah, we've had lots of questions coming in, but one that I'm going to put forward is from John Lawson. I'm going to put this to Amelia and also to Sean. And the question is, what opportunity do you see for Australian farmers in shifting towards seed oil crops for the production of biodiesel, sustainable aviation fuel and other fuels to support decarbonisation of the Australian economy?
Thanks, Sean. No, that's a big question. Look, we have seen significant growth in the area planted to canola. Most of our canola is exported to the EU for biodiesel production, and that has been a valuable market. I think domestically we have seen proposals, and there is a lot of interest there. I think particularly in WA, there's a new plant that's being proposed. How long that takes to actually be operational, it could be outside of our medium term, but it's certainly something that is gaining a lot of interest. And I think if we did see an increase domestically of crush here, say if that plant was built and there's another 1 million tonnes of demand, that would be very supportive of canola prices. And you would expect to see a shift out of less profitable crops into canola where you can grow it.
Any comments, John, on how that might impact our farm cash incomes for those cropping firms that we're seeing?
Not sorry, I don't have those numbers off the top of my head, but looking at but certainly I'd just add there's certainly, in terms of Amelia saying that area cropped increasing, but there's certainly a lot of scope compared to, say, bigger crops like wheat and barley, so there's certainly potential there.
Yeah, and I think it's one of the interesting things you guys were saying, and there's that alternative markets is effectively where it could go. And we already use it for biofuels, and then the key question for farmers is whether you get a better price domestically or you still get a price elsewhere. And there's those changing international dynamics which will also play a bit of a role in we're not the only one that's looking at this and investment and so forth and how that plays out. But I suspect, as Amelia pointed out, supportive for prices. Yep. Maybe we'll turn to the room. I've got Holly's at the back with a microphone for anyone who's game, and so I'm so blind. I think it's Curtis back there. I can hardly see the screen. So if we've got if we've got questions, just maybe say who you are and fire away.
Yeah, thanks, Jared. My name's Mark. I'm from the Murray-Darling Basin Authority. So just a bit of a technical question. You talked a couple of times about currencies like the Australian dollar appreciating or the yen depreciating and so on. I was just wondering, when you make your forecast, you talk about exports, do you actually predict the future of the currencies, or do you make an assumption that it's just going to stay the same? It just wasn't clear to me what you do. Yeah,
no, we can run through and maybe the guys can answer. I mean, obviously we predict with 100% accuracy, and so that's why we're all still here. But no, we do look at, and I don't know if you want to jump in, Fred, a bit of experience. We look at a range of different things actually.
Yeah, for sure. I mean, predicting the currencies is notoriously difficult. I mean, you can ask the RBA and Treasury, but so we usually just sort of assume a rate based on consensus forecasts. I think that's around 71, 70 at the moment, which is certainly a little bit higher than what it's been sort of in the mid-60s, but obviously still nowhere near where it also has been higher before. And yeah, I mean, currency markets with agricultural trade's also really complex because it's more about what our competitor currencies are doing, and then also in import markets, how does that currency compare to the US dollar? So I know the Chinese renminbi's actually gone up over the last sort of 6 to 12 months against the US dollar, so that's good. That's probably a factor why wool prices are sort of coming back. So yeah, absolutely we do, but it's more what's consensus saying, and then we sort of go from there.
Yeah, another thing we kind of look at is where's that source of economic growth as well. So there's the currency when we're looking at exports, but where we're expecting growth across markets, and again we're looking across all the major international forecasters and seeing where they've got prospects for growth. Keen on to understand ASEAN, China, US, Europe, and how that plays out. I think we might have another question from the floor, do we? No? Oh, I thought Holly was running around. Oh, there we go. And then we'll go take another one back from the app.
Nathan Penny from New South Wales DPIRD. Just wanted to talk to profits, farm profits, and in the livestock sector, you've got profits basically flat at or near zero at a time when prices have been at record highs. So just wanted to understand how that's able to happen and why we haven't got higher profits. And then also, you might be able to square that circle a little bit with what it means for farm balance sheets. Has there been something else happening, i.e. capital gains that are squaring that circle?
Yeah, thanks. We're going. Yeah, there we go. Thanks for the question. So part of that is, so obviously you point out like there's a big discrepancy between those cropping farms and the livestock farms with the profits. It probably, if there was a bit more context, like compared to more like the long run averages, they're actually higher than those for this year and next year. it probably goes towards like the margins of the profitability for those farms. Particularly in recent years, say like a lot of those sheep farms have been experiencing negative profits. So certainly it sometimes is a bit more of the context compared to almost like where they were at in the past, as opposed to say comparing it to the cropping or another industry. But part of the story as well is, especially of those sheep farms, those dry conditions still across southern Australia are still weighing on profits there as well. So they're probably the two factors in there. And the reason, again, it's flat year on year is really still expecting those prices high and less so about the climate conditions there in that aspect. And
just the other thing that I'll add is, one thing that we're not talking about here and when we look at averages is that distributions really matter across our industries. And so when we look at the distribution, and there's a good thing on our website and our farm data portal, which I think will, again, shameless plug, will be like showcasing at our stand. You look at farm performance by size, and you can see that there's a whole range of farms, like across, particularly in the beef and sheep industries, where you've got a range from, I guess that low end of profitability to the high end of profitability. And that distribution is also having an impact on the average. And so we are, to kind of square the circle that you're pointing at, even though we do have high prices, we do have a number of very profitable farms that are achieving good rates of return in that distribution, but there's still a tail end, particularly in those sectors. And we see that less in cropping, we see that less in dairy as well. And so that weighs on those kind of averages. And there is a little bit of capital, as you say, changes in capital stock values that we're seeing on farm at the moment. Obviously, if we get some kind of downgrades in where we think the sale yard price is going to be, that's going to weigh on what we measure as kind of economic profit, because we're looking at changes in inventories. But as Sean pointed out, it's kind of like the main story is the year-on-year story is just the balance of sales and that falling in terms of trade again. Right, Claire, should we jump to another question online?
Thanks, Jared. We've got a question here from Steve Bigno, and it's a question moving back to the fisheries sector. So this is to Harrison. Will the Western Australian commercial fish ban impact the value of the fisheries sector?
Great question. I guess it would have to technically, like by banning you are catching less fish at the moment. But hopefully for sustainability reasons, that in the long term you're going to get higher value in the future. And obviously that's a decision for the Western Australian government. But you probably won't see it in the graphs I had up before, simply because by the time you disaggregate it even to that level, there's not as much contributing to the overall picture. Like you've got one sector, the aquaculture salmon, it's taking up about a quarter of the value of the total fisheries and aquaculture picture. So obviously it does have an effect, and it does have an effect on the local fishers and the local economy there. But you probably won't see it as much in the overall picture. That being said, there is a general trend of a decline in wild caught catch as well. The aquaculture industry has certainly, in terms of value, sort of balanced that out a little.
Yeah, it's a good one, as you say. Like for fisheries, you've got to take that longer view, because we're balancing that sustainable management of a renewable natural resource against use in any given year. We're seeing climate pressures, as you are pointing out. We see them acutely in our aquaculture production, but also in our wild harvest fisheries, where it's placing pressure on some of the stocks and things are moving around. We've got heating in waters, and so it's a pretty complex environment to try and operate in. And while it might have short-term impacts, the idea is to preserve a long-term sustainable resource. I can see Ian moving around, so that must mean there's a question in the room. So let's hand over.
Hi, my name's Jess Federer. I'm a 2026 Nuffield Scholar. We're seeing increasing intensive industries within broadacre farming, particularly in the livestock sector. How is this going to be Or have you looked at how we're going to account for these and separate them or include those intensive components in long-term data moving forward?
Okay, and by that you mean, so like increased feedlotting and the like, yeah?
Yeah, well, feedlots are part of our aggregate data for sure, sitting at around, I think, 5 or 6% of number of cattle, but more in terms of when you look at like actual meat production and exports. You absolutely sit in our headline numbers. I think the growth that we've seen over the last 10 years, the fundamentals there point that will continue. Just really strong demand for grain-fed products in North Asia, but also other markets as well. As for the farm profits, I'm not too sure.
I think you do point to a good gap. So we talk a lot about broadacre farm profits, and there are extensive industries, cropping and sheep and so forth. But as the industry changes, we're not capturing that profitability story, the cost base and so forth across a wider range, and that's something that personally concerns me, keeps me up at night, and as we look to kind of restart things, like I was saying, if we want to reignite productivity growth, we kind of really need to know a little bit more about these things. So I think they're gaps that you'll hear me and other forums bang on about. A few people in the room know that I do that. But I think you're right. And the other thing is that as we talk about diversification a lot. We just spoke about that this morning as well. How are we going to start to account for what is a sheep specialist and what is a cropping farm? Those kind of things. We'll have to think about that. And then how do we account for these other revenues that we will get in as landholders are managing, like carbon revenues and the rest? Is that an agricultural activity? Is that going to be part of our kind of headline number, as Fred pointed out? So I think there's a few things on the horizon that we're going to have to think hard about to tell this story that we're trying to tell here in more detail. So it's a good question. All right, Claire, should we go for another question on the app? I can see there's a little hand here that's flashing brightly at me.
Thanks, Jared. This is a question for Vincent. What role do you see programs like the Support Plantation Establishment Grant and similar state and federal schemes? What role do you see them playing in growing Australia's domestic plantation forestry estate?
Is this a stitch-up, Vincent? You're asking questions? No. Sorry, go ahead.
No, for sure. So those schemes, of course, are designed to help us grow our plantation estate. However, when talking about that from a log availability perspective, those trees that are going into the ground now, that expansion in plantation is not going to be felt for the next, potentially 30 years until that hits the market. So with really that, we just sort of need to look forward and to think, as I said before, make sure that the supply that we're putting into the ground now, make sure that aligns with our future expectations of the market and where we think it's going to go. So it definitely plays an important role, but we just need to, at the end of the day, the most important thing there is just to make sure that our expectations of future demand we've got that supply to meet with it. Yeah.
No, excellent point. And as you say, the short-term decisions influencing the outcomes a long way out. And just to give a plug, that we did some work last year, which we called wood volumes analysis, where we tried to take that longer view to see where supply and demand, different futures, it's all uncertain, but it does give a bit of a picture as to where these kind of investments are being made in the sector, how that will play out for our future log availability and timber supplies. It looks like we've got a question. Thanks.
Hi, my name is Mohammed Samrani from the Regional Investment Corporation. I was just wondering what the panel's view is about the weakened international developments and whether there's upside from a supply chain disruption, especially in terms of wheat prices.
Let's go for a short round. Let's start with crops, and I guess that we know that uncertainty creates changes in prices. We know that there's some concern around fuel and fertiliser and input costs, but are there any upsides that might occur in terms of prices for some of our outputs, like wheat?
Yeah, I mean, I think as I mentioned before, obviously if there's any sort of production issues in Northern Hemisphere crops, that's going to be supportive of prices here. And then unfortunately when we do have poor seasonal conditions here, usually that's very supportive of prices as well. Increased domestic demand, lower domestic production, usually see higher prices. But at the moment, I think we're very well supplied with grains and oilseeds. I think there are really supportive biofuels policies which are increasing demand for oilseed crops, corn for ethanol and things. So that is increasing demand from that perspective. And if those policies continue to be positive, then that's a good story for us in terms of price growth. And for canola particularly at the moment, I think the outlook is quite positive in terms of the balance sheet is a bit tighter compared to other crops that we grow, and we might see that shift into more canola production, and particularly if we do see domestic crush expand here, there'll be less supply for the global market, and then that would be supportive of prices. So yeah, there's definitely upside. And for cropping particularly, seasonal conditions are just an absolute game changer of it. It's been so dry in parts of South Australia and Victoria, people were getting very, very nervous about the coming season. And then just over this last week, that sentiment has completely sort of shifted. There are still areas that are very dry. Southern New South Wales has missed out largely. So, there could be downside there. But seasonal conditions play the most important role, I think, in terms of the cropping outlook. But obviously supportive policies that increase demand for grains and oilseeds are also there.
And maybe, Fred and Tom, one of the interesting dynamics always when we see these uncertainties and conflicts is impacts on freight charges and insurance and so forth. Like, given our export profile, where are we sending kind of our livestock products and our hort products? Are they close or far?
Yeah, I mean, I think I was looking at the stats, the Middle East sort of wider region accounts for sort of 3-4% of global meat imports, I think. So, and then on the supply side, not really much, but yes, 3-4% will have an impact. And like you were saying earlier, there's going to be some processors, exporters in Australia that specifically target those markets. So yeah, that's obviously a real downside. And then yeah, on the freight rates have come way, way down from when they skyrocketed in sort of 22, 23. So the baseline there is really low. So any increase can probably be absorbed, which is, I suppose, a good thing.
Similar to horticulture, definitely. I think the majority of our export markets are a lot closer, so we really can tap into that freight advantage that we have with other key exporting nations into the markets that we also compete with. So yeah, similar to the livestock and to the broadacre side of things. We really can capitalise on that and continue to kind of trade into those. And if we can, consolidate those markets, I think we'll be really good, going forward.
Excellent, thank you. I might go back to a question online.
Yeah, we've got a question in here that I'm going to direct to, well, you can choose to direct it to Jared, but I think it's wider to the panel. It's from Katie McRobert, and she's asking, what does the panel see as handbrakes on Australian agricultural productivity improvement?
I think it's a great question. Katie's always got good questions. Maybe on a commodity basis, should we do? Let's start on forestry. Where do you think the kind of productivity growth or handbrake is?
So thinking of forestry from a productivity perspective, we've definitely done, my team at least, has done some work in that area. So if you want to look further into it, I'd definitely suggest you look into that work. It's mainly regarding growth in mean annual increment and sort of what all the things that the forestry sector can do towards that, whether that's through changes in silviculture or genetics, for example. So those are the many factors that sort of can contribute to increasing productivity in the forestry sector there.
Yeah, and that was interesting. And one of the things I think the challenge, like getting Katie about the handbrake for forestry, is as we shift to the more reliance for plantations for hardwoods, how do we turn hardwoods into things that can generate those higher value, like that appearance grade timbers and all the rest? And that's all about, as you say, silviculture and planting and the rest. What in our fish sectors?
Yeah.
What would you call a handbrake that's kind of hitting productivity at the moment?
Well, I think
productive fisheries are based on often like the productive stocks essentially. So yeah, just with warming oceans, some stocks you're trying to catch just might not recover as fast or have a different sort of, you know, the temperature might have a different sort of impact on its lifestyle. And yeah, if there's less stocks, it's obviously harder to catch them. So I think that's a very big watch point and something that's really difficult to understand. And I'll leave that to our scientists in ABARES, the S there. Yeah, I'd leave it at that. Yeah, climate change.
Maybe we'll go to our crops.
Look, I think cropping has been a standout in terms of productivity over the last little while, and I would say, I guess, looking at this year, it might be increase in input prices. You know, if this conflict does sort of drag on and fertiliser prices remain very high, fuel prices very high, that is going to have an impact on cropping volume, and particularly for more intensive crops like canola. It might mean that people shy away from putting in at that increased area that we were expecting because it's just going to be too expensive. So that would be a short-term thing. I think longer term, I guess it just continue to invest in the research and development that has been done because it has proved to be very good with seed varieties and agronomic practices, and you can just see from the production charts with cropping that it has been a real success story in terms of productivity. So I guess just keep investing in that and hopefully it continues to grow.
Yeah, I guess a little bit different for the horticulture and wine side of things, a bit of a duality. I think horticulture is pretty similar to broadacring in that it has been a very good kind of past couple of years, and we are really seeing these productivity improvements come through with greater production and you know, and increasing prices in that side of things. But I think more so for wine, it's a bit more structural now. And I think that's probably the biggest handbrake that we're going to see for the industry going forward. It's like, how can we restructure an industry where we're seeing, you know, quite a lot of excess supply in the market, quite a lot of excess supply of wine and wine grapes, crushing capacity, prices kind of coming down. How do we see ourselves kind of, how do we restructure going forward, and how do we kind of recalibrate moving forward to try and find that, you know, that new equilibrium? So I think, it's a little bit different to what we're seeing in broadacre, and also a little bit different between the horticulture and the wine industries at this point in time.
Yeah, on livestock, and there's lots of interesting stories and different trends on the supply side in Australia in terms of the structure of the industry, farm size, sort of touched on that. But I think the biggest thing for me would be more on the demand side in our export markets. I mean, we're exporting 80-85% of production, and we've had really good market access. I mean, we've been sort of world leading in terms of our access for beef and sheep meat, but other countries are now really starting to catch up, and so when you're starting to compete with them in the future, you're going to need productivity on farm, but also processing, logistics, transport. I mean, the growth that we've seen in Brazil has just been so strong on farm, but also off farm. So,
yeah, that's a good point. It's not just within the farm gate that we should be looking. It's across the whole supply chain. Now, do we have another question in the room, or should we go back to you, Claire? I think we're back on you, Claire.
Great, Jared. Well, I've got a question here from Henry Waller, and he's asking, beyond price forecasting, how are you evolving your models to prioritise margin capture and bottom line profitability?
That's a good question. Maybe I'll start with that one. So I mean, our forecasting approach really is to kind of look at the commodities. We do this, look at balance sheets, where the world is going, where our production and supply. We do a lot of consultation to try and get a handle on quantities, but then also what's happening with prices and dynamics in markets and so forth. So we focus at that kind of industry level and those kind of broader metrics to bring you a number of the numbers that we put up today. But we are increasingly interested in, what does it mean for our farm profits and where it goes and the like. And so with the results that Sean talked about are particularly important like that. And, we've got our Farm Predict model, which we use to look at what that means for farm profits and farm cash incomes and where the different pressures are. But as we are, I think the question is more kind of getting out as we kind of evolve and we think about market supply chains and we want to try and better understand where that distribution of value is. So, the classic is always we look at export value, it's $85 billion. We've got a $100 billion sector, and we're saying 70% of it's exported. There's a bunch of value that's created before the product leaves our export shores, and there's a whole bunch more value that's created before we consume it as consumers, in a supermarket, or we buy it from a market, or the like. And so that understanding of that distribution of value is something that we are interested in. We see that USDA take a view of that and where they go, and we've been kind of testing a few different things in that regard. But I think it's an important part for us to understand how the markets, how competitive settings are working in markets, but also then some of these opportunities. And a study that's now a little while old that we did when we looked at the vegetable industry, where we try to look at, okay, well, it's a sector that's growing, we've seen value growth, but we haven't necessarily seen productivity growth. It's very hard, extremely hard to measure productivity in vegetables. But what we did see was a big shift in the composition, the variety. So Australia used to produce, carrots, potatoes, lettuce, a few products, now produces thousands of different product variety, and that's been a real core source of value creation. And so we often, we I guess what I'm trying to say is that, when we start to evolve our view, and it's a bit like what Tom was saying about like looking for value, we talk about productivity a lot because we know it's really important for profitability, but it's not the only way. So as we evolve, I think we'll start to look at some of these changes in markets, margins, and just the different paths and stories in different industries to try and understand where that's going. So. All right. So maybe we'll go again with you, Claire.
Yeah, we've got a question here from Ben Westcott, and this is to each of the panellists, and what is the largest untapped international export market for your commodity, or the largest area for potential growth?
Who wants to start? I won't pink. Amelia wants to start. She's looking at me. So everyone else is looking away. So.
Well, of the many commodities, I guess.
Yeah. Pick one.
We export to a vast number of countries. I don't think there is really an untapped market for wheat and barley. Perhaps canola. There could be some trade shifts with the, if there are really supportive policies, and Canada consumes more domestically because they're crushing more, and that might open up markets for us in sort of those small, like Bangladesh, Pakistan, those other markets that take canola. But I think generally we do export to a really vast, like when you break it down and look at ABS data, obviously they're your headline key markets, but if you actually look at the smaller volumes that go out in containers and things, we export everywhere in the world. So I'm not sure if that answered the question, but yeah, I don't think there is an untapped market.
Yeah, it's the same on meat, like you were saying, Amelia. I'm not sure there's many markets that are untapped, and if they are, it's probably because of regulatory settings or barriers there. In beef, there's sort of the big four: China, US, South Korea, Japan. But we've seen really strong growth across Southeast Asia. Hopefully that continues, and then I guess one potential could be India. But like I was saying, there's a few hurdles there, and they've got pretty strong domestic suppliers of buffalo meat. So yeah, but great question.
I think that's similar for wine on that India comment. And I don't think it's just one country in particular. I think it's probably a region as a whole for horticulture and wine. It would be really kind of training into those Asian markets. And we're seeing that those exports are already starting to kind of tick up. So if we can kind of solidify those markets and continue to trade into them, I think it would be really beneficial for both the horticulture and the wine. We're seeing rising incomes, bigger middle class. There's this really untapped kind of populace that we can trade into. It's just about continuing to develop those trading lines and really moving into it.
Do you guys want to hazard a guess?
For fisheries, we typically export a lot of the high value product. Really keeping an eye on any market where there's an emerging sort of emerging middle class or above. We've got a pretty good fresh seafood export system. So Yeah, anywhere that's getting into Japanese style sushi. We've got tuna and salmon now, so we should be able to accommodate that.
Excellent.
Well, for forestry, it's I'd say it's more the case of Australia's now. It had a boom in its wood chip exports, but now it's sort of readjusting to demand shifting in this case, and the increasing dominance of Vietnam in the global wood chip markets is sort of challenging Australia's position there. So now it's sort of we still have that resource, of course, but now it's potentially trying to find alternate uses of the plantation estate. So whether that be through switching some of the shorter rotation, shorter to like more long rotation, where we can sort of bridge some of the gap left by native forestry, or to potentially, look into some advanced manufacturing and to find other uses for wood, essentially logs that would be chipped into more structural uses, say in the construction sector. So it's sort of, it's more about repurposing what we would have instead exported maybe to be consumed domestically instead. But just a side note on that, there is a slight uptick in roundwood exports in the last few years. Pretty much has been solely due to exporting them to India. So there is that, but I do think that that's not going to be necessarily a major export category for forestry wood products, but it's something to keep an eye on for sure.
Yeah, I find the alternate uses of timber, particularly structural timber in buildings, and for those who like to watch these things, when you come across, leaving Civic, coming across the south side, there's a new building going up with these kind of new LVL panels. Dave, who works in ABARES, and I talk about this, and I'm like, wow, there's these massive bits of panels of wood on the external of the building instead of concrete. And so, kind of coming back to that idea, there's potential challenges as we look for lower carbon intensity forms that might be all domestic rather than export.
Yeah, absolutely. There's massive potential in that area for sure, and especially how I spoke about earlier with the increasing transition to higher density and higher rise construction. That's especially a place that, if invested in correctly, could be have a lot of growth potential for the forestry sector.
Excellent. Thank you. Now, looking at the time, I think we're 2 minutes away from, is it lunch, Claire?
Yes.
Yes, 2 minutes away from lunch. So we might kind of, no, time for one more. Curtis is right. So let's do that before I wrap up.
Thanks. I think I'm the lucky last.
Yes, you are.
My name is Tuynman. I'm 2026 Litchfield scholar. We are also vegetable grower in Victoria. So just looking from the whole session is and thanks Dr. Jared for acknowledging capture the productivity in vegetable production is super hard. So just listen to today, the whole session is a lot about exporting. We can see the wine and the nuts, the growth is dramatically comparing to the vegetable is super stable. So is there any strategy or recommendation? How can we increase domestic consumption and value for vegetable growers?
I think it's a good point. And when we look at domestic vegetable consumption, it seems low, and then it's one of the things that I guess will come up in particularly our food security, and when we think about the nutrition element of where it's going, that there's scope domestically for healthier diets, and that includes the sundowner drinks. That's later, but you're right. So it's not about necessarily eating more, it's the diversity of what we eat. And our vegetable industry, is one where there should be scope as we change the varied nature of diets, get all those micronutrients and so forth. So I think there's scope, and that comes down to, I don't think there's mostly one policy or intervention that will work. It's a range of different things from, the way that products offered in supermarkets, the ease at which it's delivered, but also the awareness of consumers when they go in to understand what they're buying, and just the health benefits and all those kind of things. So I think it's mostly a multitude of different things. But you're right. We often look out. We're very exporter-oriented. Aggregate industry, but not all our sectors. And so like forestry is another example that sometimes the opportunity may lay like much closer to home. So thanks for asking the question. So with that now I've got 1 second and I've gone red. So a big thanks if you could join me in thanking the panel.